Hello, welcome to Implied Volatility. Now, let's be honest. When you were in your teenagers, much cooler than you are today, did you ever think that you'd be excited about implied volatility? And maybe I'm reaching a little bit too much. Maybe you're not too excited about implied volatility, but let me ask you this question. Is it amazing you're even interested in implied volatility? Now, I actually really like teaching implied volatility because when I was learning about options, this was the one thing that didn't make any sense. This is the one thing I couldn't get my head around. And so when I finally got it, I thought, oh, why didn't anyone ever explain it to me this way? And it actually made me think that, oh, maybe there's a better way to explain this. So let's jump into implied volatility. And implied volatility is part of the Greeks. So the Greeks, we have delta, we have gamma, we have theta, we have Vega, and we have rho. So implied volatility is part of Vega. Vega is the part that measures volatility. And implied volatility is a different kind of volatility than just normal straight volatility. So here is the definition taken off of Investopedia. What implied volatility does is to estimate the underlying asset's possible magnitude of move to either direction. The higher the implied volatility, the more the stock is expected to move, and hence a greater possibility that the underlying asset will move in your favor. The lower the implied volatility, the more stagnant the stock is expected to be, and hence the lower the possibility that the stock will move in your favor. Alright, now I read stuff like this, and I'm like, wow, I think I understood about 60 to 70% of that. Now I know that there's people smarter than me that really did understand all of it. And then there's some of you that are new to the finance world that you said, I didn't understand any of that. So let's go to another definition. Alright, this definition is a little bit more clear. Implied volatility of options is determined by the market maker's assessment of public expectations regarding events that might change the value of an option. Alright, so just that one sentence there, it's really determined by the market maker. And I want to expand that term market maker. If you don't know what a market maker is a company that makes a market in a security or an option, meaning that they've paid money to be one of the market makers, and they by default are always buying and selling an option. And what we see when we look at our quote on the screen is simply a collection of all the market makers and their bid and ask for a security or an option. So that first sentence says that the market makers, they get to basically judge the public expectations, and they get to move the value around of an option. The next sentence says, in one-sided markets, market makers are charged with the obligation to sell options to buyers in order to maintain liquidity. One of the things a market maker must do is they must always make a market. What that means is that when somebody wants to buy, if there's no seller across the country that wants to sell that security or that option, the market maker has to step up and fill that order. They have to step up and fill that order if there's no one there. It solves the problem of what if I want to sell and no one's there, or what if I want to buy and no one's selling. The market maker fills that role in the market. So because the market makers are basically forced to make trades in illiquid securities, the market gives them the ability to basically move that premium around, or the price around, or the spread around, in order to make it to where they can actually make a profit of this. Next sentence, they then increase the value of the options through increasing their assessment of implied volatility so as to reap a greater profit. Conversely, when the market is selling off options, the market makers are charged with the obligation to buy, and they lower the price of the options through the lowering of their assessment of implied volatility. Alright, that definition, probably again understood 60, 70, 80% of it. And I know that when I first started out trading, would have understood even less. So I'm a big believer of learning through analogies, learning through examples. For me, that's the way that I like to learn, and I know a lot of people, they learn a little bit better. So we're going to take what I think is the best way to understand implied volatility. And this is the way that I wish it was explained to me at first, because when I finally was thinking about it and thinking, okay, how does this work and what does it mean? And I thought about Vegas. I thought about sports betting. And finally, the green light, or the light bulb went off in my head. And I'm like, oh my gosh, I get it. I finally actually understand rather than sort of understand. I'm going to take a recent example, Super Bowl 50. Now, Super Bowl 50, it was the Denver Broncos against the Carolina Panthers. And if I remember correctly, the Panthers were 15-1 through the season, and the Broncos were like 12-4. So what Vegas does is actually very similar to what the options market does. Vegas is all about odds. Everything in Vegas is about what are the odds of it happening and what's the payoff. Remember, when we went through the Black-Scholes formula and we talked about options pricing, it was that teeter-totter. If you wanted a high likelihood of something happening, you had to, by default, take a lower payout. If you wanted to go for a long shot, the payout had to be worth your time to go for that long shot. So that's how Vegas works. And Vegas works exactly like the options market. It's all about probabilities. Now, it's always amazing to me how good Vegas bookies are. 40 years ago, the Vegas bookies had to do it all by hand. It was pretty amazing where they had to go to experts. They say, okay, how well do you think Peyton Manning is going to do in this game? And, how well do you think this receiver, and who's got the better defense? If any of you have ever seen the movie Moneyball, the movie Moneyball is a really cool movie in the fact that it really takes the statistics of sports and puts it into a formula. And if you don't know the story of the game of Moneyball, it's where the Oakland A's, they hired up this young kid to be their general manager, and he basically said that we need to pick every player based on statistics, not based on other things. And he broke it down to where he said, all the winning teams in the past had a second baseman who had a batting average of 225, they did this, they did this, they did this. So they actually went out into the market and found a baseball player that fit those statistics that they were looking for. And so they built this team that no one really understood. Why did they build this team? It didn't make any sense. And they ended up winning the whole thing. And it was a real proof of statistical analysis in sports. And now I'm going to say all professional sports use statistics in one way or the other. And Vegas does the same thing. So they basically take all the statistics of all the games ever played, and they know that, okay, if the Carolina Panthers have a 6'5" receiver that has 90 receptions in a year, they know that the average output for that receiver in a Super Bowl is X. And then they know that if a quarterback is playing in his first Super Bowl, this is the penalty. If he's playing in his second Super Bowl, this is his plus. So they put everything into statistics. And it spits out what the projected winning or losing team will be and how much they should win by. That's all that Vegas does. So on Super Bowl 50, the Carolina Panthers were favored by 5 points. Now, if you take a look here at the Las Vegas line, I actually grabbed this online, you can see that the line was 6. Now, this is a great little thing to show because now we're going to talk about implied volatility. So everything I just talked about, all the past stats, they all went into the computer and it spit out what should the results be. So in the Black-Scholes formula, everything that's put into the price of an option, things like what's the price of the stock, how close is it to the strike price, how much time is left in the option, stuff like what's been the historical volatility. We're going to talk about historical volatility in a second. What has the historical volatility of the option been? All of that goes into the computer, into the Black-Scholes formula, and it spits out, okay, this is what should happen based on statistical analysis. Let's now talk about implied volatility, because implied volatility is not based on what has happened. Implied volatility is based on what could and what expectations could happen in the future. So as I said, when the game was finally started, the line on the game was the Panthers by 5. And you can see here, it's the Panthers by 6. So what the bookies do in Las Vegas is that they are allowed to move that line based on a few things. One of the things that happened was that a lot of people came out and started to bet on the Broncos. And this is why I imagine that they moved the line down. Remember, in Vegas, they don't really want to pick a side. Vegas makes money by the spread. So, if you bet, and again, this is going to be a bad example, but let's say their line is something like, 5.5. What they're saying is, okay, we're going to get a half a point on each side. If the team wins by 6, we're going to get a half point. Team loses by 5, half point. Hopefully that makes sense, but they really truly want to have as many people betting on the Broncos as they do the Panthers. If they get an even amount, they're guaranteed to get their spread. They're guaranteed. So if there's a lot of people betting on one side, remember, like the market makers, they have to take everyone's bet based on their published line. The market makers must take every trade based on their published line, which is their current bid and ask. If there's too many people on one side, the bookies don't like it because they might have to pay out quite a bit. So what do the bookies do? They move the line. They move the line to discourage more buyers from coming in and encourage more people to come in on the other side, because in the end, they want equal number of buyers and equal number of sellers. They want equal numbers for the Panthers as they do for the Broncos. They're just looking to capture that spread. So if there's too many people betting on one side of an option, you're going to see implied volatility change. The market makers are going to change basically the line or the price of the option. Let's now talk about expectations. So that's one of the things that affects implied volatility is the actual buying and selling of options. If there's more people buying options, the market makers are going to move implied volatility higher, which is going to make options more expensive. If there's more people selling options, they're going to move that line lower. They're going to move implied volatility lower to capture that event. So the actual buying and selling of options affects implied volatility, and also expectations, which is kind of a derivative of what people actually do. But let's use our Super Bowl 50 example. Let's say that a report comes out that Peyton Manning might get the flu before the Super Bowl. Now, in all of the modeling, in all of the statistics they did, there's no way to put into the statistics of what's happened in the past, all the games the Broncos played, all the games the Panthers played, all the statistics. There's no way to put that into current modeling because it hasn't happened yet. It's simply a future expectation. It hasn't happened yet. So what happens is the expectations of something happening. Let's say that news came out that Peyton Manning may not play in the Super Bowl. What's going to happen is that's going to affect the line. Why? Because people's expectations are now different. Their expectations are now different. So instead of the Panthers by 6, that line might move to the Panthers by 10, by 12, based on the expectations of people and the actual bets they're putting down. Let's say it came out that the Panthers quarterback, Cam Newton, may have to miss the game because of a family issue. All of a sudden, that line's going to change. Why? Nothing in the past changed. Historical volatility didn't change. How close the stock was to the option didn't change. Nothing changed. Time value didn't change. What changed was people's expectations of future value. So if the news came out that something may change or may happen, that line is going to change based on people's expectations. And that's exactly what we see in the options market with implied volatility. Let's say that Apple has earnings coming up. And let's say that, and understand that the Black-Scholes formula, it calculates how volatile Apple is typically around earnings. It knows that there's an earnings report coming up. So it's going to take a look back at maybe the past 4 or 5 or 6, I don't know exactly how many are in the formula. What was the average move of Apple around those 6 earnings reports? And the Black-Scholes formula is going to price that in the value of the option. But let's say that people are expecting the earnings to be even bigger this time. Let's say that Apple introduced a new product in the fourth quarter. Now remember, that doesn't get picked up on any of the statistics. Just like we talked about with the Super Bowl, that's not in the statistical analysis. The historical volatility, how much time until the option is going to expire, how close is it to the strike price, none of that captures that Apple brought out a new device. And their earnings might be much better or much worse than expected. So what has changed is people's future expectations. And so because of that, the implied volatility actually gets bigger. People are expecting there to be a bigger move in the past from Apple. Now it works the other way. Let's say there was a very volatile stock, and let's say some news came out that calmed the stock down. Let's say there was a company that was involved in lawsuits. And let's say the lawsuit was finally settled and there's no more uncertainty about it. That doesn't get captured in the statistics. The statistics will still show high historical volatility based on all that. But now that it's done, implied volatility is going to shrink. It's going to go lower because of people's expectations of what the future value is going to be. Now I hope that that little walkthrough helped you understand a little bit more about implied volatility. For me, that was the thing that really kind of made some things click. When I thought about sports betting, when I thought about, the reports that come out that, Peyton Manning might, might not be able to throw a ball, that changes the perspective. That changes the possible outcomes that everyone is looking for, and that changes the value. That changes the value of the option quite a big deal. All right, so looking at volatility. Implied volatility is the expectation of what's going to happen in the future, and historical volatility is what's happened in the past. Now, this is pulled from iVolatility.com. iVolatility.com is a great website for anyone who wants to really get into volatility and being long and short volatility trades. I'm not a huge fan of these because I think volatility is a wild card at best. I think it's very difficult to forecast. But you can go in on any option. You can take a look at historical versus implied volatility. And there's a couple of strategies and there's a couple of sessions that we do where we really talk about this historical versus implied volatility. So let's quickly just get these terms out of the way. Historical volatility is the actual volatility of the past. As you can see in this spike here, volatility went from 15% up to 35%. That's a big jump in volatility. Sorry, historical volatility is the purple. So what I want you to look at is that down here, historical volatility was at its low. But look at where implied volatility was priced. The market sniffed something out. Look at that. The market sniffed out that there was a potential move coming because implied volatility was closer to 14%. Historical volatility was down here at about 7%. The market's pretty good at forecasting future moves, and you can see that at this point, all the way up here, historical volatility is actually higher than implied volatility. Implied volatility is definitely the leading indicator. Definitely the leading indicator. Now I know that some people use this. I don't, but you can choose to use this if you want. People always ask me the question, well, Rob, how do you know if an option is priced too high or priced too low? And the answer to that is based on its historical versus implied volatility. If implied volatility is priced higher than historical volatility, you would theoretically say that that option is expensive. If historical volatility is higher than implied volatility, you would theoretically say that this would make that option cheap because you're paying less for the future expected volatility than historical volatility is shown. Now this to me is one of those things where in theory it sounds good, but in reality I don't think it works all that well. And it's the same thing with trend following. And you guys have all heard the adage that expensive stocks tend to get more expensive. If you take a look at the stuff like the Netflix, you take a look at the stuff like the Amazon, they're very expensive stocks. What do they do at bull markets? They tear. They go up 40, 50, 60, 100, 200%. They get more expensive. And then the value stocks, what do? They don't go up much at all, they go down. So I don't really love looking at this historical and implied volatility as a way to look at whether options are cheap. I like to look at implied volatility as kind of a window into what's likely to happen. So if I see implied volatility is priced higher than historical volatility, it's a good sign to me that the stock behavior is about to change. It's likely to get more volatile. So with that in my mind, I think to myself, you know what? I want to make sure I have a strategy that either benefits from a rise of volatility or a strategy that is negated volatility. This is not something I check very often because I think it doesn't give you all that great of an edge. I know that some of our traders do, and that's fine. But to me, this is quite an extra step, and I see this little step talking more people out of good trades than into good trades. You know, hey, everything looks great on a chart, everything looks great on the trend, everything looks great on their sector analysis, but they go in, they say, oh, implied volatility is a little higher than I like, and they don't make the trade, and they end up missing out on a good trade just because of that one little thing. But I wanted to show this to you, historical volatility versus implied volatility. Now you can go get implied volatility and historical volatility at any time you want on ivolatility.com if you want to see them compared to each other, or you can go to the options chain. And at some platforms you might have to add in implied volatility and historical volatility, but you can see these numbers at any time. Alright, the last thing I kind of wanted to talk about was called the volatility smile. So basically, the volatility smile, you're going to see this, is that when implied volatility rises, you're going to get an increasingly large volatility smile. Because let's think about what people do. And again, it's all about people's actions. What do people do when they expect a big move in the underlying stock? What do most people go out and do? They go out and buy out of the money calls or out of the money puts. So again, the market makers, they react to all this and they see this increase in people buying out of the money calls and puts. So what happens is they raise the implied volatility on the out of the money options because this is where all the big bets are being made. And what you see is you see that the at the money options, their implied volatility may stay the same because that's not where people are making all the bets. Now theoretically, without implied volatility, there would be no volatility smile. The volatility line would be even because all that we would take a look at would be historical volatility, and that would be the same across all strikes. But because of implied volatility, we see this volatility smile. So let's think about what this means. If you have rising implied volatility, it's actually telling you that number one, the out of the money and the in the money options are going to be more expensive. They're going to be more expensive than they would have been, or more expensive than they had been, because of the expectations. So that tells you, okay, if I'm going to do a strategy and volatility is high right now, implied volatility is much higher than it's been in the past, then it's a little warning sign that's telling me, okay, the out of the money calls and puts are likely to be priced more expensive. It may actually be better for you to take a look at in the money, sorry, not in the money, but the at the money calls and puts. Those aren't going to be priced as expensive based on implied volatility. When the volatility smile is closer to flat, it's telling you that the out of the money calls and puts are not more expensive. Now here's the ultimate irony of this, because I see people all the time thinking, oh, then I want to buy out of the money calls and puts when the volatility smile is flat. When the volatility smile is flat, it's telling you that no one is expecting there to be a big move. Now, either you need to know the future, or you need to have insider information. Because, look, Wall Street is really good at knowing the future. They have analysts that are talking to people, running projections. So the irony is, don't run out and buy out of the money calls and puts just because they're cheap based on volatility, because it's a signal to you that it's very unlikely that there's going to be a big move in the trade. I've always found that the greater the volatility smile is, the more directional you want to be. Meaning that there is a real high probability of there being a big move. That's all it's saying, is there's a higher probability of there being a big move. So when I see that, I want to choose strategies that benefit from potential big moves and strategies that have limited risk if a move goes against me. If I see a flat volatility smile, it's telling me that I actually probably want to be more sideways on the stock, that there is not much expectations for a large move. So I want to be looking at probably some more stagnant strategies. I have found that just like with trend following, when a stock's in an uptrend, you want to buy it. I know that a lot of us say, oh, I want to go against the grain, I want to be different. History has shown, statistics have shown, that you're better off going with the trend. I'm going to go ahead and say the same thing with volatility. When volatility is rising and it's high and higher than normal, you want to be doing strategies that will benefit from large increases in the underlying. If you have low volatility, you want to be doing low volatility trades. You want to be doing stagnant and sideways trades. I've found that just like with the trend, you want to be with the trend. Alright, now the purview of this session is not to get into strategies. The purview of this session is to really help you understand implied volatility and how it works. But there's definitely strategies where you can specifically play volatility only. Long volatility, things like the straddle, the strangle, the condor, the butterfly, those are just a couple. The short condor, the short butterfly. Those are just a couple of ways that you can say, hey, I'm only playing volatility on the long side. Or you could play short volatility. Hey, I think volatility right now is high. I think it's going to be going lower. Well, great. Your plays would be the short straddle, the short strangle, the condor, the butterfly, some ratio spreads. So basically, the thing I love about options, and I tell people, when you're just a stock trader, you're only trading delta. That's it. That's it. You're only trading direction. Nothing else matters. Volatility doesn't matter. Time decay doesn't matter. If you're buying and selling a stock, the only thing that matters is direction. When you are playing with options, there's three things that matter: direction, time, and volatility. You really have to think about all three of these things when you go into the market. What's the direction, or what's your target? What's the effect of time, or what's my time frame? And what are the possible changes in volatility? So again, direction, time, and volatility. You can be long or short all of these. You can be long direction, you can be short direction. You can be long time, long theta, you can be short theta. You can be long volatility or long Vega or short Vega. In conclusion, volatility is the second most important thing behind the underlying movement in the stock. So of course, your target is always the most important. Where's the price of this stock going to be based on my time frame? My time frame is 2 months. Where's the price going to be? After that, you're going to see that volatility will actually have quite an effect on a lot of your option strategies. Once we get into each strategy, we will discuss in detail how changes in volatility will affect all the strategies. So when we get into something like a diagonal call spread, we're going to have a section on, okay, how is volatility going to affect this? If volatility goes higher, how does this affect our trade? If volatility goes lower, how does this affect our trade? It's very important to understand those, because I've seen times where people do a diagonal spread. The stock does what they want it to do, but they only end up breaking even on the trade. Why? Because volatility. Volatility changed. Or I've even seen times where people make a trade, the direction doesn't do what they want it to do, but volatility rised, and they made a profit. I've seen that before as well. So we want to make sure that all of our traders understand volatility. Now, implied volatility is the wild card, and everything else is a formula. If you take a look at delta, delta is a formula. Theta is a formula. Gamma is a formula. Formulas aren't wild cards. They happen. They're guarantees. Implied volatility is the wild card, and implied volatility is the one thing that you have really no idea what it's going to do. And to me, this is where, kind of the bet is in options. Is that options, it's always going to price out the statistics of it happening, and it's going to price out the payoff and to the associated risk. That's a formula. Implied volatility is where things can change. Implied volatility is where things can get too expensive. There are times where stocks can literally get too expensive. There's times I go in to do a trade around earnings, and I look at the prices and I say, I can't play this. This is too expensive. And that actually says, okay, well then can I take a look at the other side of the trade? Is there a short Vega trade that makes sense in my strategy? So this implied volatility, this is the wild card. We don't know where it's going to go. We don't know how it's going to change. It's the wild card. Now, if that kind of scares you a little bit, that's good, because it should. Again, whenever you have a wild card in trading, trading is very systematic, very methodical, but all of a sudden we throw in this wild card that you can't control and have no idea. Understand that changes in volatility only affect positions that are not held until expiration. Why? Because implied volatility will always go to zero at expiration. It's always going to go to zero. So if you're in a spread where you're long volatility and short volatility, they're both going to go to zero and they're going to negate each other. So there will be no effect of volatility on any positions that are held till expiration. Now, we're going to talk about that when we get to strategies. We're going to talk about strategies that are held till expiration. We're going to talk about strategies that you may get out before expiration. Any strategy that you may get out before expiration, volatility is going to affect you, and you have to know how it's going to affect that. But any trade that you're planning on holding to expiration, volatility is really not a factor. Now, it's going to change the price during the trade, but at the end of the trade, you're going to get what you're going to get based on the risk graph at expiration. All right, thanks for joining me for Implied Volatility, everybody. And hopefully you're now a little bit more nerdy than you were before. All right, thanks, everyone.